Did you know that since 1928, the US stock market has experienced a significant crash roughly every 7 years? That's almost like clockwork, folks. Except wait, what? There hasn't been a definable setback in nearly 5 years, and before that almost 12. Oh my, what does this mean? Will we get a double crash, or crash twice as hard for twice as long? These crashes have become almost a predictable part of the financial landscape, shaping the way investors and economists approach the market. Each crash, while devastating in the short term, has also provided valuable lessons and insights that have helped to build a more resilient financial system over time. The really smart investment historians use the cycle to their advantage, and we will show you how you can too. In this video, we will share a gem of information with you so that you can turn that fear into opportunity. Let's start with a little history. 1929, Wall Street crash. This is perhaps the most infamous crash triggering the Great Depression. The market plummeted in late October 1929, with losses far exceeding 20%. 1973 to 1974, stock market crash. This period saw a significant decline due to factors like the oil crisis and economic instability. 1987, Black Monday. On October 19, 1987, the stock market experienced a dramatic single-day drop, with the S&P 500 falling by more than 20%. 2000 to 2002, dot-com bubble burst. The collapse of the dot-com bubble led to a prolonged decline in stock values, particularly in technology stocks. 2008, global financial crisis. The financial crisis of 2008 caused a severe stock market crash, with major indices experiencing substantial losses. 2020, COVID-19 crash. In March 2020, the onset of the COVID-19 pandemic triggered a rapid and sharp decline in stock markets worldwide. This isn't about doom and gloom, it's about facing facts. Understanding the cyclical nature of the market allows us to make informed decisions rather than reacting out of fear. By educating ourselves and staying informed, we can navigate these turbulent times with confidence and poise. Market crashes, just like rainy days and tax season, are an unavoidable part of life. They are events that we know will happen, and while they may be inconvenient or even challenging, they are also opportunities for growth and learning. By accepting their inevitability, we can better prepare ourselves to handle them when they come. Get ready to hoard cash. But here's the good news. Just because we know they're coming doesn't mean we have to be terrified. In fact, with the right preparation and mindset, we can even find opportunities in these downturns. Many successful investors have made their fortunes by buying when others were selling, taking advantage of lower prices to build their portfolios. Think of it like this. If you knew a storm was brewing, wouldn't you pack an umbrella and wear your wellies? The same principle applies to the stock market. By preparing for the inevitable downturns, we can protect our investments and even thrive during challenging times. That's exactly what we're going to do here, folks. We're going to learn how to read the signs, understand the patterns, and develop strategies that will help us weather any financial storm. It's about being proactive rather than reactive. By understanding market history and embracing preparation, we can approach these events not with fear, but with a calm and collected spirit. Knowledge is power, and by arming ourselves with the right information, we can make informed decisions that will help us navigate even the most turbulent times. Remember, every down market has been followed by an upturn. History has shown us that while downturns are inevitable, so too are recoveries. By staying the course and remaining patient, we can come out stronger on the other side. So here is your gem. There has never been more than about a 7-year period since the 70s that the S&P 500 has carried a loss. This means that if you could hold from selling, keep investing, and not need the money for at least 7 years, you will most likely come out ahead based on modern history. This time is probably no different. With the right preparation and mindset, we can face the future with confidence, knowing that we have the tools and knowledge to succeed no matter what the market throws our way. The first thing to remember when the market takes a tumble is simple. Don't panic. It's easier said than done, but keeping a cool head is crucial. When you see red numbers and falling graphs, Your instinct might be to sell everything and cut your losses. But that's often the worst thing you can do. We've been here before, and we've come out stronger on the other side. Remember 2008? The financial crisis was a dark time for many, but those who stayed the course often found themselves in a better position when the market recovered. Or how about the dot-com bubble burst in the early 2000s? Tech stocks plummeted, and many investors lost fortunes overnight. Yet the market eventually bounced back and new opportunities arose. Each time people panicked, sold everything and lived to regret it. Panic selling locks in your losses and prevents you from benefiting from the eventual recovery. History has a funny way of repeating itself, but it also offers valuable lessons. By studying past market downturns, we can learn how to better navigate future ones. These market downturns are natural parts of the economic cycle. Just as the economy grows, it also contracts. This cyclical nature is something every investor should understand. Just like the changing seasons, the market goes through periods of growth and contraction. Spring brings growth, summer brings abundance, fall brings harvest, and winter brings rest. The market follows a similar pattern. Understanding this cycle is crucial to navigating it successfully. By recognizing where we are in the cycle, we can make more informed decisions and avoid the pitfalls of panic selling. It's like riding a roller coaster. There are thrilling highs and stomach-churning lows. But the key is to stay seated and not jump off mid-ride. There are going to be ups and downs, twists and turns. The market is unpredictable, and trying to time it perfectly is nearly impossible. But if you hold on tight and remember that the ride eventually comes to an end, you can actually enjoy the experience. By staying calm and focused, you can weather the storm and come out stronger on the other side. When the market takes a dive, it's easy to let fear get the best of you. We see our hard-earned savings dwindle and we start to panic. But here's the thing about fear. It often leads us to make irrational decisions. We sell low, buying high later and losing money in the process. One of the biggest misconceptions about market crashes is that they signify the end of the financial world as we know it. Let me tell you folks, that's simply not true. Yes, crashes are unsettling, but they're not the apocalypse. Instead of viewing these events with fear, let's try to see them for what they truly are. Opportunities. Opportunities to buy low and potentially sell high later. Opportunities to reassess our financial goals and make sure we're on track. Just like a general prepares for battle, we need to prepare for financial uncertainty. And the best way to do that is to build a strong financial foundation that can withstand market fluctuations. Step 1 is creating an emergency fund. This is your safety net, your rainy day fund, your "oh no, the roof is leaking" money. Aim for at least 3 to 6 months of living expenses tucked away in an easily accessible account. Next, diversify. Don't put all your eggs in one basket. Spread your investments across different asset classes: stocks, bonds, property, maybe even a bit of gold. Diversification helps mitigate risk and protects your portfolio from being wiped out. Another pro tip is when you feel the market is topped out, you could put an extra small piece, like 10 to 20% of your investments, into something more secure. Then WGen, you see that 20% decline, you could take a piece and buy back in. Just a thought for you to consider. A tale of two investors, when preparation met panic. Let me tell you about two friends, John and Sarah. They both had a keen interest in the stock market and spent countless hours researching and discussing their investment strategies. Both were savvy investors but had different approaches to market downturns. John was always on edge, constantly checking the market and reacting to every dip and rise. John, prone to panic, would sell his investments at the first sign of trouble. He believed that by doing so, he could avoid further losses, but this often led to hasty decisions. Sarah, on the other hand, had a plan. She spent time crafting a well-thought-out strategy that included various scenarios, ensuring she was prepared for any market condition. She had diversified her portfolio, maintained an emergency fund, and regularly reviewed her investments to ensure they aligned with her long-term goals. And most importantly, she stayed calm. Sarah understood that market fluctuations were a natural part of investing and didn't let short-term volatility shake her confidence. When the market crashed, John panicked and sold everything, locking in his losses. He couldn't bear the thought of losing more money and acted out of fear. Sarah, remembering her plan, rode out the storm. She knew that the market had its ups and downs and that staying the course was crucial for long-term success. She even used the opportunity to buy more stocks at a discount, knowing that the market would eventually recover. Her calm demeanor and strategic thinking paid off. Years later, John regretted his impulsive decision. He realized that his lack of preparation and emotional reactions had cost him dearly. Sarah, however, reaped the rewards of her patience and preparation. Her investments grew significantly, and she achieved financial success. This story highlights the importance of having a plan and sticking to it, even when things get tough. Preparation, patience, and a calm mindset can make all the difference in the world of investing. Weathering the storm, your financial toolkit. So, how do we put this into practice? It's simpler than you might think. Start by building a diversified investment portfolio that aligns with your risk tolerance and financial goals. Remember, diversification is your best defense against market volatility. Next, establish that emergency fund. This will provide a financial cushion and prevent you from making rash decisions during a downturn. Think of it as your financial armor, protecting you from unexpected events. Finally, avoid timing the market. It's tempting to try to buy at the very bottom and sell at the very top, but even the experts struggle to do this consistently. Instead, focus on a long-term investment strategy like dollar-cost averaging. Knowledge is power. Stay informed, stay ahead. In the world of finance, knowledge is your most valuable asset. Staying informed about market trends, economic indicators, and global events can help you make well-informed decisions and avoid common pitfalls. Read financial news, follow reputable financial experts like yours truly, and don't be afraid to ask questions. The more you understand about the market and how it works, the better equipped you'll be to navigate its ups and downs. Remember, knowledge empowers you to make rational decisions, not emotional ones. And in times of financial uncertainty, clear-headed thinking is paramount. Join the conversation. Share your story. Secure your future. We've covered a lot of ground today, from the inevitability of market crashes to the importance of preparation and staying informed. But the conversation doesn't end here. I want to hear from you. Have you ever experienced a financial crisis? What lessons did you learn? What strategies have helped you navigate challenging times? Share your experiences, insights, and questions in the comments below. Let's learn from each other and build a community of financially savvy individuals who are prepared to weather any storm.